Picture this, it's London, 1720. The city is buzzing with a new, intoxicating idea, a way to get rich, and get rich fast. Everyone from lords and ladies to maids and shopkeepers is talking about one thing, the Southsea Company. It promised unimaginable wealth, a golden ticket to a life of luxury. But this golden ticket was actually a ticket to financial ruin, a catastrophe that would become known as the Southsea Bubble. Today, we're going to unravel the story of one of the greatest financial crashes in history. How did it happen? Who was behind it? And what lessons can we learn from this 300-year-old disaster? To understand the Southsea Bubble, we need to go back a bit. To the end of the War of the Spanish Succession in 1713, Britain was victorious, but victory came at a steep price. The government was drowning in debt, around £30 million, which was an astronomical sum back then. They needed a creative solution, and fast. Enter the Southsea Company. It was founded in 1711 by Robert Harley, the Chancellor of the Exchequer. The idea seemed brilliant on the surface. The company would take on a huge chunk of the national debt. In exchange, the government would pay the company a steady stream of interest, about 6% per year. But here's the real kicker. The company was also granted a monopoly on all trade with the Spanish colonies in South America. Think about it, gold, silver, spices, all the treasures of the New World. The name Southsea itself conjured up images of exotic lands and limitless riches. The problem? This monopoly was mostly fantasy. Spain still controlled South America, and they weren't exactly keen on letting their British rivals waltz in and take their resources. The trade agreement, Tratado de Negros, only allowed the company to send one ship per year and engage in the slave trade, which, while profitable, was nowhere near the gold mine investors were imagining. The company's actual trading profits were minimal. But in the world of finance, sometimes perception is more powerful than reality. The real game wasn't about trading goods. It was about trading stocks. The directors of the Southsea Company knew their business prospects were shaky, so they focused on something else, inflating the value of their own stock. And in 1720, they hatched a truly audacious plan. They proposed to take over the entire British national debt, all £30 million of it. This was a bold move. To convince the government and the public, they started a massive hype campaign. They spread rumors of incredible trade deals and secret treasures. They bribed politicians and influential figures with shares to get them on board. It worked. Parliament approved the deal, and the public went into a frenzy. Everyone wanted a piece of the Southsea Company. This is where the psychology of a financial bubble really kicks in. The price of a single share in the Southsea Company started to skyrocket. At the beginning of 1720, a share was worth about £128. By February, when the new deal was announced, it jumped to £175. By March, it was £330. By May, it had soared to £550. People were gripped by what we now call FOMO, the fear of missing out. They saw their neighbors getting rich overnight and thought, I need to get in on this. Stories were everywhere of ordinary people making fortunes. A maid who became a lady, a clerk who retired to a country estate. People sold their homes, their businesses, their family heirlooms, all to buy Southsea stock. Logic went out the window. The higher the price went, the more people wanted to buy, convinced it would go even higher. It seemed like a new era of permanent prosperity. The mania wasn't just limited to the Southsea Company. This period saw the rise of hundreds of other speculative ventures, known as bubble companies. People were investing in the most absurd ideas you can imagine. A company for a wheel of perpetual motion, a company for importing jackasses from Spain, and my personal favorite, a company advertised as being for carrying on an undertaking of great advantage, but nobody to know what it is. People literally lined up to give their money to a project whose purpose was a secret. That's how wild things got. The directors of the Southsea Company fanned the flames. They offered installment plans, allowing people to buy shares with just a small down payment. This was like pouring gasoline on a fire. It allowed even more people to speculate with money they didn't really have, driving the price up even further. By June 1720, the stock reached its dizzying peak, hitting over £1,000 per share. The company was, on paper, worth more than all the land in England. But here's the thing about bubbles: they always pop. The smart money, including many of the company's own directors, started to see the writing on the wall. They knew the price was completely detached from the company's actual value. Quietly, they began to sell their shares, cashing in their massive profits. Isaac Newton, one of the greatest minds in history, was an investor. He sold early, making a nice profit. But then he watched his friends get even richer, got swept up in the mania again, bought back in at a much higher price, and ended up losing a fortune, around £20,000, which is millions in today's money. He later famously said, "I can calculate the motion of heavenly bodies, but not the madness of people." The turning point came in the summer of 1720. The company's rivals, those other bubble companies, were a nuisance. So the Southsea Company pushed for the Bubble Act to be enforced, a law designed to shut down these unauthorized competitors. It worked, but it had an unintended consequence. It created a wave of panic. As these other bubble companies collapsed, investors got spooked. They started to question the value of all stocks, including the Southsea Company's. Suddenly, everyone wanted to sell. But with everyone selling and no one buying, the price began to plummet. It was a stampede for the exit. From its peak of over £1,000 in June, the stock fell to £700 by August. By the end of September, it had crashed all the way back down to £150. The bubble had burst. The fallout was catastrophic. Fortunes were wiped out in an instant. People who had been rich one day were bankrupt the next. The public was outraged. They had been lied to, manipulated, and robbed. They demanded justice. A parliamentary inquiry was launched, and what it uncovered was a cesspool of corruption, bribery, insider trading, and outright fraud. Key politicians and company directors were found guilty. Their estates were confiscated to compensate the victims, and some were even thrown into the Tower of London. The Southsea bubble was a national trauma. It shattered public trust in the financial system and the government. But it also led to important reforms. The government, under the leadership of Robert Walpole, who is often considered Britain's first Prime Minister, managed to stabilize the economy and restructure the company, preventing a total collapse of the financial system. It was a painful lesson, but it helped shape modern financial regulations. So, what can we learn from a 300-year-old story? Well, the Southsea bubble shows us that human nature doesn't change much. The desire for easy money, the fear of missing out, the tendency to follow the crowd, these are powerful forces that can lead us to make irrational decisions. It's a timeless warning about the dangers of hype and speculation when they become detached from real value. Every time we see a new investment craze, whether it's .com stocks or crypto tokens, we can hear the echoes of the Southsea bubble, reminding us to look past the hype, do our own research, and remember that if something seems too good to be true, it probably is. Thanks so much for watching. If you found this dive into financial history interesting, please hit that like button and subscribe for more stories like this one. See you next time.